If you've been following me for a long time, you know that I've had a couple core positions most of 2023, and many of these even going into 2022, like Amazon, like Dropbox, and even Crocs. But one of my newest positions, and one that I just started buying into just within the last 2 or 3 weeks, is PayPal, and it currently makes up about 20% of my invested net worth. Now, PayPal is one that's done pretty good so far, but it's a brand new position, so I can't really judge it yet because it's only been a couple of weeks. So far, we're up 5%, right at about $1,000 in profit, but this could evaporate maybe tomorrow because obviously we just started, and a 5% gain is nothing to get excited about. Now, we've done pretty well so far here in 2023. We're at a new record high today, almost reaching up to 59,000. I'm excited for that 60,000 mark that's going to be coming up soon. But we're going to be talking about the good, the bad, and the ugly with PayPal because there's a couple things in particular that I think are really good with this company, things that are going to really benefit them over the next couple of months, couple of years, and then a couple of things that are not so great, some things that are going to lead to competition issues. And honestly, there's two major threats to PayPal that I see that we're going to talk about in this video. But overall, thank you so much for joining. Check out M1 Finance down below in the description if you want to get signed up for a free $100 referral bonus. But other than that, guys, thank you so much for watching, and let's go ahead and get started by looking into PayPal stock. Now, like I said, I have about 20% of my money invested in this company, and it's a company that has performed very well operationally over the last several years. It's a company that's had growing revenue, and even with many companies slowing down their revenue growth last year, they still grew about 8.5%. They grew from last year a $25.37 billion revenue number to this year $27.52 billion revenue number. Now, so far, they're still growing. If you look at this on a quarter-over-quarter basis, you can even see in the most recent quarters they're still growing. Last quarter, they grew 3.44%, and it is slowing quite considerably, and that is something that you need to take into account. But overall, analysts are projecting to finish out this year right around $29.58 billion, which is 7.5% growth rate. Now, this company is growing, and also their profitability, I think, is going to see a lot of major improvements because while the revenue has been growing, the free cash flow has been growing, but just not in a way that I find really attractive. It's been kind of stagnant over the last 2 years, which I do not like. That's not something I like from a company like this, and I think this is going to turn around very soon. Why do I think this is going to turn around very soon? Elliott Management is a major hedge fund worth billions and billions of dollars. Now, they're taking a large stake in PayPal, and there's mainly three main things that they're looking at addressing. They're looking at A, cost cuts in a new board seat at PayPal, and they're going to use that board seat to force major cost cutting, mostly from reduction of employees, getting rid of loss leaders of the business. The margins are needing to improve, which goes hand in hand with those cost cuts. They should be better for a high fintech company such as this. And then finally, their Venmo asset, which in my opinion is probably their most valuable part of the business in terms of something that is growing and is actively seeking revenue and profitability growth for an older company like PayPal. Now, I think Elliott Management is very serious about this, and I do think that they will focus on the three main key bullet points here. But basically, I think these investors are going to keep them in check, or if not, they're just going to vote them out of the whole company. Now, that's one of the main bullish drivers for me. That's one of the things that I'm excited about, similar to like Elon trying to revamp Twitter, make it bigger, make it better, make it more efficient. I think the next item is something that gets me really excited as well. Buy now, pay later. Now, I don't care if we're talking about PayPal. I don't care if we're talking about Klarna. I don't care if we're talking about any of the other services out there. Pretty much when it comes to it, if you're the lender, if you're the person who is needing to get paid back on a buy now, pay later scenario, they are far more risky to me than a credit card because there's not nearly as many punishments and the loans are significantly smaller, almost like microloans, and they're harder to get paid back. Now, PayPal and KKR, which is an overseas corporation, is buying back billions of dollars worth of these loans, and this is going to create upfront capital for PayPal. Now, if you look down here, subject to certain conditions, this transaction is expected to close in the second half of 2023. Upon closing, PayPal expects this transaction to initially generate approximately $1.8 billion of proceeds to be used for a combination of increased capital return to shareholders and general corporate purposes. Now, if you keep reading here, it says that following closing, PayPal expects to allocate approximately $1 billion to incremental share repurchases in 2023, contributing to an updated outlook of approximately $5 billion in total share repurchases this year. Now, as if the company already wasn't going to buy back a ton of the company's stock, you can see that now they're going to start buying back even more. Now, here's what's great. And let's go ahead and look at the shares outstanding for this company. You can see that generally speaking, going back to about 2014, this company has consistently bought back a little amount of shares every single year, generally buying back around 2% or so, 2.5% of the company's stock every single year. Now, let's look at the share price. Where's the company been over the last 5 years? Well, 5 years ago, it was actually at a higher price. 5 years ago today, it was actually $86. Where do we trade at today? Today, we close at $69.28. So 5 years ago, the company was more expensive to buy than it was now. Now you can see all along the way here, we went from the 80s, the 90s, went even up here all the way up to about 115, and then COVID happened, we reached 120, and then it went down all the way down to around the $70, $80 mark, and then we trickled higher and higher and higher post-pandemic gains, and we broke $300. This company buying back stock at the $300 range is not efficient in my opinion. And also the valuation was significantly higher than where it needed to be because it frankly just got out of control. So it free fell and it went down and down and down. And the good part about that is now, as an investor, I'm not buying this stock at $300. If I woke up tomorrow and it was $300, I would sell every dime I have in the company tomorrow, which actually leads me to where I'm going to be selling this company here in just a little bit. But now the company can be buying back. Let's just look over the last year. Most of this past year, the company's been at a high at about $100 to a low of about $60. This company is buying back shares at $50, $60, $70, $80, $90 a share versus $150, $250, $300 plus, and this gives them a lot more opportunities to buy back stock, especially when they're having an influx of cash like they are here from this KKR agreement, having billions of dollars coming up front, and more importantly, it de-risks the company, in my opinion, from the most risky segment of the business and gives them $1.8 billion to use upfront within the next 6 months that they're going to be able to use. Now, those are the good parts of PayPal. The good parts of PayPal, it's growing. It's lower than it's ever been. Share buybacks are picking up. If you look at the earnings per share they're projecting this year, with the company sitting at about $70 a share, they're actually projecting right at about $5. So if you take the PE ratio on this, you can see that it sits almost exactly at a 14 PE ratio. Not that bad, far below the average in the market, and one that I'd find pretty attractive for a growing company that has revenue growth opportunities like this one. Now that's all great. That's all fine and dandy. Now you might be asking, Jordan, why is it one of the smaller positions in your portfolio? And in fact, I may even end up reducing this a bit. I may reduce it to maybe say somewhere between 10 and 15,000 if I were to guess, because honestly, I'm really on the fence keeping this a $20,000 position. So I'd love to hear your comments down below, and it's for two main reasons. The first one is Apple Pay. I think a lot of these big tech companies, Apple Pay, Google Pay, and then also a lot of the other competitors that compete directly with old school PayPal, companies like Stripe, can start to potentially take market share, especially these big tech ones like Apple and Google. The Apple credit card and Apple Pay is skyrocketing in uses, and that could potentially take away from PayPal and Venmo usage. Now, I do think that this is one that does need to be focused on. I think that this could be a long-term competitor to PayPal. It reminds me a lot of like ChatGPT. It's a new customer, it's a new competitor entering the market, and this is something that could take market share. They have a huge market share already, and so there's not a lot to go up, more so a lot more to go down from these big tech companies that are coming in with incredible technology and already have a large usage base, and that could potentially hurt PayPal as the Apple credit card and specifically Apple Pay eat into the market share of PayPal. Now, there's lots of other competitors, and I could be scared of all of these, MasterCard, Visa, Zelle, and lots of other names out there, but really, the other thing that I'm focused on, that I'm really worried about beyond Apple and Google, is FedNow. FedNow is something that is about to come out. It's out like now. It's basically coming out now. And this is something that is really going to be an awesome intermediary for a lot of banks and transfer payment services. It's going to be awesome for consumers, awesome for banks, and it's basically going to be an instant 24/7 service that processes transactions despite holidays, despite weekends, the time of day. Doesn't matter. It will process transactions for very, very cheaply, very, very fast. Now, the thing I want to note here is that I was reading about this and I was researching it, and Forbes themselves says in the question, does FedNow replace money apps like Venmo and Cash App? The Fed has made it clear that FedNow is not intended to kill or replace other money transfer options like Venmo, Cash App, PayPal, or Zelle. Rather, it is meant to work alongside the current systems built by the private sector. Now, here's the thing. Because it's not out yet, because I haven't got to see it or use it myself, it's hard for me to fully understand what this process will look like. Now, that does give me some vote of confidence here, seeing that the Fed is saying that, saying, hey, we're not trying to destroy PayPal or Venmo or these other options that are out there on the market. We're trying to work alongside them. This is supposed to supplement what is already being released. Now, that's great, and that does give me a little bit of confidence, but I don't know. It's a little concerning, something that this powerful by the federal government can come out and can potentially threaten directly a core business for PayPal, and this could really affect them in a positive or negative light, seeing how they end up working directly with the FedNow system. Now, in most cases, I'm going to say that this is probably going to be a negative for PayPal rather than a positive, and so it is something that I'm taking into account. And going back to PayPal stock here and its valuation, a 14 PE ratio is pretty cheap, especially for one that's growing its revenue, probably about to start growing its free cash flow at a much faster pace. And honestly, the shares outstanding are probably about to start going into a free fall. If you look at it on a quarterly basis, I think right now you can see that the company's buying back around 2.5% of the company's stock. I think that's supposed to increase probably upwards of 3+%, 3-4% annually, and these shares outstanding are going to go down and take the valuation even cheaper. Now, that said, a 14 PE ratio is decently cheap, but it's not an absolute rock bottom valuation. It's not trading at, a 10 or a 9 or 7. That would be absolutely ridiculous. But I don't think that it will go much lower given the circumstances unless we see real deterioration in the business. So as of right now, I'm holding 300 shares. I'm considering taking down my position to 200, especially if we can get a little uptrend here. We had a big decent 3.72% gain today. I'm already on the fence about reducing my stake to 200 shares. And so if we see an uptrend to the 70s, or heck, even if we don't, I might just think harder about this position and whether or not I want 2/3 of the size I have now, which I very well might. I'll let you guys know. Comment down below if you think I should keep all 300 or reduce it to 200. But regardless, this is a position that I'm in right now over the next couple of months, maybe over the next year or so as it recovers. And I'd look to exit my position as we get upwards towards around $100 mark, all 300 shares. But thank you guys so much for watching. I appreciate you watching all the way, and check out all the stuff down below in the description, including getting signed up for M1 Finance, which will give you a $100 referral bonus. But other than that, guys, thank you so much for watching, and I'll catch you all next time.